Older homeowners, do not overlook this. IRS deadline on May 19th. The IRS is now using newer data tools that were not available a couple of years ago to spot mistakes on tax returns connected to homes. If you are a homeowner over 60, there is a real possibility that a matching issue already exists in the system. That is not a claim about any one person. It is the result of a process built to compare property records, lender reports, rental platform payments, and estate filings against filed tax returns. The system is active now. It is finding mismatches, and seniors with homes that have built up significant equity are among the people most likely to receive attention. I am going to explain exactly what the IRS is checking. The 4 home-related transactions that can trigger automatic review for older homeowners, and the 5 steps you should take before May 19th to protect yourself. But before I get into that, I need to tell you something many people do not understand about how this works, because it changes how seriously you should take the next 20 minutes. For decades, the IRS had limited staffing, older computer systems, and too few resources to fully verify whether a tax return matched reality. Audit rates fell to historic lows. Compliance problems went unnoticed for years. Millions of Americans, including many seniors, made normal financial decisions involving their homes without realizing those choices could create reporting obligations. They added a child to the deed. They took out a home equity line of credit to cover medical bills. They rented out a spare room on Airbnb. They inherited a property from a spouse or parent and simply kept living in it. Every one of those actions can create a specific tax reporting requirement. For years, almost no one was caught because the IRS did not have the tools to check. That changed in 2022 and 2023. Congress approved roughly $80 billion in additional IRS funding through the Inflation Reduction Act. A significant share of that money was directed toward enforcement and technology. In practical terms, that meant more computers, more cross-checking, and more automated notices. The IRS used it to build automated data matching systems that pull information from sources that were not previously connected. County property records, mortgage lender reports, title company records, short-term rental platforms like Airbnb and Vrbo, and estate and probate filings. That data now feeds machine-based systems that compare it with every tax return linked to the property owners involved. The system is not searching for bad intent. It is searching for mismatches. A deed transfer with no Form 709, a 1099K from Airbnb with no Schedule E, a home equity loan with an interest deduction that does not line up with how the money was used, an inherited property sale with no documented basis. These are not judgment calls. They are data comparisons. When the system finds a mismatch, it can generate a notice automatically. By the time that notice arrives in your mailbox, the review has already been done. The IRS is not asking whether there might be an issue. It is telling you it found one worth reviewing. Now let me walk you through the 4 specific triggering events, because there is a good chance at least one of them applies to you or someone close to you. The first and most common trigger is taking out a home equity loan or a home equity line of credit and using the money for something other than home improvement. This has become very common among seniors in recent years. Inflation has pushed up the cost of groceries, utilities, prescription drugs, and everyday living expenses. Many older Americans have turned to their home equity as a financial resource. Maybe you used a HELOC to pay off credit card balances. Maybe you used it to help a grandchild with college tuition. Maybe you needed it for a medical procedure that insurance did not fully cover. Those are understandable decisions. But here is what many lenders do not make clear. Under current tax law, specifically the Tax Cuts and Jobs Act of 2017, which is still in effect, home equity loan interest is only deductible if the borrowed funds were used to buy, build, or substantially improve the home that secures the loan. IRS Publication 936 explains this plainly. If the money was used for anything else, medical bills, debt consolidation, tuition, or ordinary living costs, the interest is not deductible. If you or your preparer claimed that interest on Schedule A, you now have an incorrect deduction on file that the IRS can identify through lender data matching. The penalty structure starts with the extra tax that should have been paid, then interest from the original due date of the return, and then a possible accuracy-related penalty of 20% of the underpayment. For a senior living on a fixed income, that combination can easily add up to several $1,000s. The second triggering event catches more people off guard than almost anything else: adding a family member to your home's deed. Many seniors do this with the best of intentions. You add your adult son or daughter to the deed so the property transfers automatically when you pass away without probate. Or someone told you it might help protect the house from Medicaid recovery. Or you simply wanted to make life easier for your family. Those reasons make sense from a planning standpoint. But from a tax standpoint, adding someone to the deed is not just a paperwork change. It is a transfer of a partial interest in real estate, and the IRS treats that transfer as a gift. Under the tax code, a gift can become a reportable event when the value transferred exceeds the annual gift tax exclusion for that year. If your home is worth $400,000 and you added your child as a 50% owner, you transferred $200,000 in value. That can create a filing requirement for Form 709, the United States Gift and Generation Skipping Transfer Tax Return, for the year the transfer occurred. If that form was not filed when required, that is a reporting issue with its own consequences. And this part matters even more. When you give property away during your lifetime, the recipient generally receives your original cost basis, not the current market value. That is called carryover basis. But when someone inherits property at death, they usually receive a stepped-up basis, meaning the basis becomes the fair market value on the date of death. The difference can be enormous. If you bought your home for $80,000 30 years ago, and it is now worth $400,000, a child who inherits it at your death may receive a stepped-up basis of $400,000 and could sell it with little or no capital gains tax. But if you gifted them a 50% interest while you were alive, their basis in that half could be only $40,000. If they later sell, they could face capital gains tax on the difference between that basis and the sale price. We are talking about tens of thousands of dollars in tax exposure created by a decision that was made with good intentions, but without complete information. The IRS can now identify these unreported gift transfers by comparing county deed records with Form 709 filing records. If a deed change appears in county records and there is no matching form, the system can flag it automatically. The third triggering event involves rental income from your primary residence. This has expanded quickly because platforms like Airbnb and Vrbo make it very easy to rent out a room, a basement, or even the entire house while you travel. For seniors on fixed incomes, the extra few $100s a month from renting a spare room can make a real difference. It can be the difference between staying current on property taxes and falling behind. The appeal is completely understandable. But the moment you start receiving rental income from any portion of your primary residence, the tax character of that portion changes from personal use to income-producing use. That means the rental income generally must be reported on Schedule E of your tax return. You also have to allocate expenses properly between personal and rental use, and you need to account for depreciation on the rental portion, which affects your basis and the amount of taxable gain you may have if you sell later. Under current reporting rules, platforms like Airbnb and Vrbo can issue Form 1099-K when payment thresholds are met during the tax year, and a copy goes both to you and to the IRS. So, if you received rental income through one of these platforms and did not report it, the IRS does not need to guess. They already have the data. Their matching system compares the 1099-K against your filed return. When the income does not appear on Schedule E, the system can generate a notice. One of the most common is the CP2000, which is an automated underreporter notice. It is not the same as a full audit, but it still matters because it is a computer-generated proposal that assumes you owe tax on the unreported income, plus interest, plus a possible accuracy penalty. If you do not respond within 60 days, the proposed assessment can become final and collection actions may begin, including the filing of a federal tax lien against property in some cases. The fourth triggering event is the inherited property documentation gap. This one is especially difficult because it often affects people who were already dealing with one of the hardest moments of their lives when the mistake was made. When you inherit property, whether it is your deceased spouse's share of the family home or a vacation house from a parent, the tax code provides one of its biggest benefits, the stepped-up basis. That means your cost basis in the inherited property is generally the fair market value at the date of death, not what the original owner paid decades earlier. This can dramatically reduce or even eliminate capital gains tax if you later sell, but the stepped-up basis only works if it is documented. If the estate did not get a qualified appraisal at or near the date of death, if Form 706 was not filed when the estate was required to file, or if there are no records establishing the property's fair market value at the time of inheritance, then you may be holding property with an undocumented basis. Under the IRS's current enforcement posture, missing basis documentation can create a serious problem if the property is sold. That is because the IRS may question the basis you claim, and without support, the assessment can become much larger. If you sell an inherited property for $300,000 and you cannot show what the stepped-up basis should have been, the IRS can challenge the gain calculation as if your basis were much lower. On $300,000 of gain, that could mean a tax bill of $45,000 to $70,000 or more, depending on your income and filing status. The IRS is now identifying inherited properties through estate filings and probate court records and matching them against later sale records to see whether proper basis documentation exists. Now, I know the question that may be forming in your mind. How could the IRS possibly track all of this? How would they know you added your daughter to the deed 3 years ago? How would they know you rented your basement on Airbnb last summer? How would they know your mother's home was never properly appraised when she passed? The answer is that 2026 is very different from the years before it. In many states, county recorder offices now have data sharing arrangements that allow recorded deeds, title transfers, and liens to enter federal databases. Mortgage servicers report loan originations, balances, and interest information directly. Title companies report closing transactions. Rental platforms report payments. Estate and probate courts report filings. All of that information feeds the same system. The system does not sleep, it does not take weekends off, and it can process millions of records at once without missing a match. That is why these issues can surface even when a homeowner never expected the IRS to connect the dots. So what should you do? Let me give you 5 specific steps you can take right now. Step 1. Gather every document connected to your home and your home finances going back to 2022. Find your original purchase records, the closing disclosure from when you bought the house, and records for every major improvement. A new roof, a kitchen remodel, a bathroom addition, new windows, a new HVAC system. Under IRS rules in Publication 523, the cost of permanent improvements increases your basis, which can reduce the taxable gain when you sell. Many seniors have put tens of thousands of dollars into their homes over the years, but never kept the records in one place. That missing paperwork could be costing you money. Then gather any home equity loan or HELOC statements, the original loan agreement, and annual statements that show how the funds were used. Look for any deed or title documents showing ownership changes. And if you have been renting any part of your home, collect your income records and platform statements. Step 2. Take your last 3 filed tax returns and compare them with those documents. You do not need to be a tax expert to do this. You are simply looking for things that do not line up. Did you take out a HELOC, but there is no mention of it on your return? Did you change your deed, but there is no Form 709 in your records? Did you receive rental income, but there is no Schedule E? Did you sell or transfer property, but there is no Form 8949 or Schedule D? You are not fixing the issue yet. You are finding out whether one exists. Step 3. Bring what you found to a qualified tax professional, specifically a certified public accountant or an enrolled agent who has experience with real estate taxation and IRS penalty procedures. You can find an enrolled agent through the National Association of Enrolled Agents, and you can find a CPA through the American Institute of CPAs. When you call, ask one simple question. Do you have experience with IRS penalty abatement for real estate-related compliance issues? If the answer is yes, you are likely speaking with the right person. Step 4. Create an account at irs.gov and access your tax transcript. This is one of the most powerful and underused tools available to taxpayers, and it is free. Your transcript shows every return processed under your Social Security number, every notice or assessment the IRS has issued, and the third-party information that has been matched to your account. That can include W-2s, 1099s, and 1099Ks from rental platforms. Setting up the account usually takes about 15 minutes through the ID.me verification process. Once you are in, you can see what the IRS sees. If there are notices pending that you did not know about, they may appear there. That is how you stop guessing and start knowing where you stand. Step 5. If you already received IRS notices and have not responded, deal with them immediately. Every notice has a response deadline. If the deadline has not passed, respond before it does. If it has passed, contact a tax professional right away, because an unanswered notice does not go away on its own. It moves forward. An unanswered CP2000 can become a statutory notice of deficiency. That can become a final assessment. A final assessment can become a collection action. A collection action can lead to a federal tax lien on your home. That progression usually happens over months, but every step makes the problem harder and more expensive to resolve. I also need to warn you about something just as serious as the tax issues themselves: scammers. Every time there is a high-profile tax story affecting seniors, fraud attempts increase within days. You may get calls from people claiming to be IRS agents and demanding immediate payment. You may receive emails with official-looking logos asking you to click a link. You may hear from companies promising to make the problem disappear for a large upfront fee. The real IRS starts contact by mail through the United States Postal Service. They do not call and demand instant payment. They do not threaten arrest over the phone. They do not accept gift cards, wire transfers, or cryptocurrency. They do not send emails asking for personal information. If anyone contacts you and tries to create urgency around immediate payment, treat it as fraud. Hang up, delete the message, do not engage. Here is the bottom line. The IRS now has more data, more technology, and more enforcement capacity in 2026 than at any point in its history. Homeowners, including seniors, can be flagged more easily now because so many home-related transactions leave digital records. The window to come forward voluntarily and ask about any available penalty relief is open now, but it narrows significantly after May 19th. The steps are straightforward. Gather your documents, compare them to your returns, speak with a qualified professional, check your IRS transcript, and respond to any open notices immediately. You did not necessarily create this problem on purpose. In many cases, people made reasonable decisions about their homes without anyone explaining the tax consequences. But understanding that does not change what needs to happen next. What changes your result is action, informed action, timely action, and specific action taken before the deadline. If this gave you clarity, share it with anyone over 60 who owns a home. One share could save someone thousands of dollars. Subscribe because these updates continue throughout 2026, and leave your questions in the comments. Your situation could become the topic of the next video. I will see you in the next.